that's
absolutely appreciate that. Again, it's where you're painting the picture. You need to position yourself in order to be to purchase a home in the right way. I guess to try and say it in layman's terms.
Yeah.
Let's see. Next one I have is how does an investment loan work? So if they're looking for an investment property and they're looking for a loan, how would that work?
Okay, so we have to determine first, people say investment. When I answer the question, I'm referring to I'm buying a property, it's going to be for rental, I'm going to rent it out, and I'm keeping it, long term, a few years or more. Okay, that's different than I'm buying an investment property, I'm looking for financing because I need money to go in, rehab it, fix it up, and then I'm going to flip it, sell it, a few months later. Gotcha. That's a different type of investment. So the in terms of investment to be able to purchase a rental property, it's the same as any other financing. There's no VA financing, there's no FHA financing, so it's just conventional. You can put as little as 15% down. I don't recommend it. Because we go back to that you're approved versus what the terms are. Exactly. You definitely get really whacked on the terms. The sweet spot is 25% down.
Gotcha.
People think it's just 20. Sweet spot is really for the good terms is 25% down. Okay. And what the reason why the larger down payments are required is because the banks want to see that you've got some skin in the game. If you get an investment property, typically you also have a property that's your primary residence. Exactly. And so what they look at is, if you were to lose your job or you were to have a financial situation that comes up, or let's just say, just like it happens all the time, you rent to someone and your renter loses their job. Yeah. They can't pay you. Right. What are you going to do? So now you've got a mortgage to pay at home, and you also have a mortgage to pay on the investment property. Mm-hmm. And so the way to look at it is, okay, well, if you don't have the money because the money's not coming in from the renter, and you only had a few months of reserves, set aside, now you're going to have a decision to make. Yeah. Do I not pay the mortgage on the rental property, or do I not pay the mortgage on my private residence? Most folks are going to skip the mortgage payment on the rental property because, hey, they don't live there. Exactly. Okay. And so they're going to focus on the primary. And so if that mortgage doesn't get paid and you end up losing the property, you're probably going to figure out a way to make that payment or make something happen if you put 25% down on it. Exactly. Yeah. But if you only put 5% down or 3% down, it's like, whatever. You might just kind of chuck it, Mm-hmm. You're willing to take that loss or take that L, but majority of folks are not trying to take an L on a 25% down payment that they make. And so they want a bit more skin in the game, because when you are purchasing your primary residence, I'm able to then analyze your income, your assets, your credit to determine whether or not you can make those payments. When you have an investment property, you're having your renter in that property. I'm not evaluating the renter's ability, and so there's a lot of there's a big risk on the bank's part, because we're hoping that the homeowner, the landlord that we just gave the loan to, we're hoping that they have the ability to assess their renter's situation the same way we did. And the difference between us and them is, if someone doesn't pay us, it's a bank. We can still operate and still maintain because we have funds, we have money. Versus an individual, someone's not paying you, you don't have an endless amount of reserves set aside to cure you. So, so it's a lot of times it's people they balk about that, but typically what happens is a lot of the guidelines and the things that you have to do, not just to save to help the bank, but it's also to protect the buyer. Exactly. You can't You can buy rental property all you want to. It's a great deal. It's a great idea. But people do rent properties, and a lot of times they run into financial issues and they can't pay you. What do you do in that situation? No one really thinks about that.
Or they don't
so
plan for it.
It's not like the cable TV shows.
Yeah.
That's the parts they get it out.
Don't be following HGTV. Yeah. It's all peaches and cream.
It can be really, really good in most cases. I've seen a lot of people who made a lot of money, in rental properties and built up a huge portfolio for themselves. But just like stocks, some stocks are going to do well, some stocks are not going to do so well, and you have to kind of have a balance.
That makes sense. Yeah. Okay. Great. Very informative. Let's see. The next one here is, if I have a VA loan already, can I apply for a conventional loan at the same time?
Meaning that I have a home that's a VA purchase. I have a home and I'm going to rent that property out and then buy another property and get a conventional loan without selling that house.
Right.
Yeah, you can. Yeah, that's not a. There's nothing that stops a person from doing that. And you would just get the conventional home the same way you would do any one other conventional home. The difference is when we do your debt to income,
we have to include that.
Now we're counting car, student loans, all of that, and then we're also counting the mortgage that you have on that current property. Now, if you've been renting it out, we can also count the rental income to help offset it.
Gotcha.
But some people they're getting rent, but they're not applying it to their tax returns. So you can't just provide a lease. We have to show that have you been claiming it as income on your tax returns? Or you may have someone who's, I'm renting to family. And so they just pay me, $1,000 a month. Okay, well, it's still rental income. You still have to claim it.
Gotcha.
And so if it's not on your tax returns, you're not claiming it, then now we have to absorb the entire mortgage payment of that property into your debt to income. And that's why sometimes people will run into issues on being approved for the other home. But whether it's family there or it's not, you kind of still have to treat it in a business manner. It's still an investment property, even if your mom is living there. If she's paying your rent, we need to see documentation of that so we can not count that against you. Definitely you can do that. I would say the better answer to that is why even get a conventional loan if you got VA financing? But a lot of times what a lot of folks don't understand is if you have a VA loan, you can get another VA loan if you can't have like two primary residences, but in some cases we can get you another VA loan for your next primary. A lot of veterans or military folks, they get moved around.
Right.
So hey, this was my primary residence and now I got shipped over to the other side of the country.
Right.
Okay, so VA makes it a bit more simple to be able to do that because you kind of don't really have a choice. It's not like I've got a VA loan in Dallas and I want to get another one, down the street. Okay, well, you try to get an investment property.
Exactly.
Kind of case by case basis, but I would say the first thing we would want to do is to see whether or not can we get that person another VA loan versus before we go conventional. Because if you've got VA benefits, it's just the best loan that's out there. You can't get any better than that, in my opinion. No money down, no PMI to pay. They have an upfront kind of mortgage insurance premium too. They call it a funding fee, but that's still drop in the bucket compared to if you had to get a conventional loan. So I would more that type of client I would explore if it's possible to get them another VA loan in addition to the one they have before we went the conventional route.
Gotcha. Yeah. See that? There you go, my veteran brothers and brethrets. Great information. I hope you guys are taking notes and paying attention because I'm almost finished. So I hope you're taking notes. Second to last question. How is the pandemic affecting the lending industry?
I would say part of it's hard to determine like in all the ways that it's had an impact. But I would say, right initially, you went from having, mortgage corporations or banks that are traditionally all of their staff is housed in one building, and so now you had to, all of a sudden March, April hit, you had to have this immediate disbursement of, now we're putting people that used to be working, side by side in an office, and now we're having them working from home, but banks also have to maintain, we have privacy issues. Gotcha. So you can't just send all your employees home with a laptop, right? And not be concerned about, your client's social security numbers and date of births and all that stuff. And so that created a bit of an issue because everybody's home environment is not like their environment is not as controlled as you can make it in the corporate environment. So that changed a bit. So sometimes we've seen like where the sense of urgency in certain areas are not as there. People are distracted working from home. Yeah. There's Netflix, there's a refrigerator, there's kids, there's a pool in the back. Yeah. And so folks get lazy of it, when you're working from home sometimes. But what we've seen is that since with COVID, you've got businesses either shutting down or whether long-term or temporary, then that creates job losses. And even there's a lot of people who, whether they lost their job or not, they might have experienced a reduction of income for a certain period of time, or it might be an indefinite period of time. And so we're seeing where lenders have been a bit more concerned about their criteria has increased a bit. You know what? I used to take chances and say, hey, we'll take somebody with a 580 credit score, 600 credit score, but now, you know what? It's just, we're not going to take those risks anymore. We're going to up our requirements to make sure that we're not dealing with a rash of foreclosure activity, 2 years, 3 years from now due to COVID. So, we've seen basically a tightening of the guidelines a bit, which is going back to the first few questions as far as making sure people are properly prepared. If you're prepared, nothing's really changed for you. Gotcha. It's those fringe folks that are kind of on the edge that haven't prepared to buy a house. That's where we're seeing the difficulty in getting those people to the closing table. But for the folks that are already having been preparing to buy a house, paying their bills on time, they've been budgeting, they've been saving, not really an issue for them. The good thing about it, the rates have kept going down, so that's the other positive effect. But for the most part, man, it's been business as usual. We're seeing some, like I say, some in operations where things have kind of sometimes taken a little bit longer than what they have normally been. They're just checking things out a bit farther. They're really making sure, since there's no job losses, they're really doing a lot more verification of employment, a bit more strict, even sometimes the day of closing, they want to call, I want to verify, is this person still working there? Right. You want to verify, okay, maybe you've given your pay stubs, still want to contact your employer, hey, is this income on the pay stub, is this still accurate? Oh, wow. Okay. Because we don't want to close a loan based on income that you used to make. Right. And you don't want to buy a house based on income that you used to make. Exactly. So that makes sense. Yeah, so those type of things I would say just kind of keep it light. Those are some things. There's some things probably internally, but that we deal with as professionals within the industry that may have changed. But speaking of, I think the audience most likely probably more concerned about things that impact them. So I would say those are the top ones that I can think of. Okay, great. Well, see, just an additional question, because you had kind of mentioned it, and I'm sure that's a question out there. Right now, I guess, given the pandemic, on average, how long have you been seeing it
take to get to closing? Once they're approved and everything's good to go in the beginning, how long have you seen on average through this pandemic getting to closing?
Standard 30 days.
Okay.
Yeah. Even sooner in some cases. Yeah.
Not much has changed too much.
Yeah.
Okay.
We're still getting done in those time frames. The industry is. We had since when the rates dropped, we had a big rash of refinance activity coming in.
Yeah.
And so you had a lot of banks that got just bombarded with thousands and thousands of people every day, originating refinance applications. And so, but most lenders are still focused on purchase business, and so that's kind of where they put a lot of their energy in the purchase side of things, because the purchase side of things, there's a contract in place and there's a certain date you got to close. Mm-hmm. And what happens is where we're seeing kind of the delays are more in the refinances.
Gotcha.
Refinance, hey, you're already in the house, you don't have any contractual obligations to another party, right. You're not moving.
Gotcha. Okay.
We'll get to that when we get to it, and so there's still a focus on purchases, and that's why we're not seeing those time frames increase. The other issue too is different lenders based on their rates. And sometimes you're shopping around different lender. Okay, well this one has a lower rate, this one has a higher rate. That's why. Why is that? Lenders sometimes we artificially increase rates intentionally, even if the market hasn't changed, because we're just trying to slow down the applications coming in. It's like, okay, if we keep taking applications at this particular rate, we don't have the staff to close that purchase within 30 days. And so they're always kind of forecasting that. And kind of mentioned the other question, that's one of the difficulties. One of the changes in the business that I did mention is staffing. So rates go down, business picks up, there's this need, now we need a bunch more underwriters, need a bunch more processors, a bunch more closers, but then for how long?
Right.
Rates could be down for a while, and you come in on next Monday and all of a sudden they went up. Yeah. Now the applications have slowed down.
I don't need these.
Now I don't need these people anymore. Yeah. But I didn't rent office space for them. Yeah. I've purchased equipment for them, software for them. I've trained them.
Right. So I've invested.
Yeah.
So now I gotta keep them.
So there's this mentality of like, how long can we go with what we have before we can't anymore? And now we have to then train new people. Then think about the people that train. If you start too late, then you have to get them up to speed. And then there's delays in that because their learning curve isn't there anymore. They're trying to learn the system and learn the process, and you kind of throw them in there into the fire. Yeah. And so you see delays there, and then by the time they catch up to speed, the market might have already changed. Yeah. So it's it's kind of a weird thing, because the last thing you want to do is bring a bunch of people on and give them a job, and then 3 months later tell them, oh, sorry, we don't need you anymore. You don't have a job anymore. And then 2 months later, rates go back down again.
Hey, we need you back. Come on back, please.
Yeah, it's a weird thing, man. It's So I've seen that happen over the years too. So that's pretty much a challenge for the bank. And so I always kind of ask clients that
take that into consideration.
Yeah, it's COVID-19, and people are dealing with a kind of a pandemic. First time in my lifetime I've seen something like this before. You got to give companies time to adjust. Just like we all had to make adjustments and things like that. You kind of have to understand that behind the scenes, a lot of people are making these adjustments. So you're making plans. People will think things like, oh well, my lease is up on the 30th, and so I want to close my new house on the 30th. Don't do that.
Don't do that. Yeah.
I mean, you leave
ahead.
You're giving yourself no time for any mistake that's going to happen. So if your lease is up on the 30th, you want to be closing in your house on the 16th or the 15th. Give yourself a couple weeks. If there's a delay, something happens, you just never know. You got some time. You're not under pressure. Man, I got the U-Haul packed. I got to be out by midnight tonight, or they're going to start charging me.
Exactly.
So give yourself some lead time. It may cost you a little bit of money, but That's just a little bit of an insurance policy that you have so that you're not sweating bullets if something was to get delayed. It's the mortgage industry, real estate industry, things happen, can't control it sometimes, So adding the additional pressure.
I honestly didn't, me personally didn't even think about the challenges the banks had to deal with receiving those additional applications on the day. I didn't think about that. Thank you. I didn't even really think about that. Okay, last one. And this one, a lot of people have this question. The question is, who are and what is the role of an underwriter? Who are these people behind this door that no one sees? These mythical people who come back and they say, they want to see this in your bank account. They want to know why you did this transaction and who is this money go to and blah 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 blah. And they, in the consumer's eyes, they delay the process or make the process longer or make it difficult to the consumer.
Actually, man, they don't exist. They're just invisible.
They're just invisible.
They're aliens. No. In reality, what a lot of people don't realize is that most of the deals that we do are they're already pre-underwritten.
Gotcha.
So I take a client, I get their application. We have these automated systems. Okay. Most people have heard of Fannie Mae before, they've heard of Freddie Mac before. They might not know what they do, but they've heard it on the news, whatever. So these agencies, we'll just start with those two to make it simple. These agencies, they have, it's called automated underwriting systems, called AUS, automated underwriting system. And what happens when you apply, I have your application, and it's an electronic form on my computer.
Right.
I have your credit report. I have that in electronic form on the computer. And so what happens is, I literally hit submit.
Mm-hmm.
From my system, it goes to that automated underwriting system, and it's like a brain, like a software engine, and it just thinks. Mm-hmm. And what it's doing is it's analyzing very quickly, within 40 seconds.
Oh, wow.
Or sooner.
Wow.
It's analyzing person's credit, their credit utilization, their debt to income, their assets, reserves, the type of property, how much you're putting down, how much you'll have left over in your bank account after your down payment and closing costs, whether you're using a gift or not, whether you've ever been late,
right,
credit card or mortgage before.
40 seconds.
If it's a condo versus a 2-unit, it's an investment versus a primary, it's an FHA versus this. It's taking those entities, Fannie and Freddie, they've written the program within the software to look for certain things, and there's certain things that are weighted. And so they know what type of deal they want and what type of deal they don't want. Okay, and that software is there to basically crunch the raw data to determine and spit out basically yes or no.
Right.
Okay, so it spits out a yes. Great. That's when we get approval, and guys like me tell you, hey, you've been pre-approved for your mortgage. Okay, and so at that point, really, the loan has already been, in essence, really underwritten.
Underwritten. Okay, gotcha.
Okay? That's why it says kind of invisible.
Yeah.
Okay. It's really underwritten. What the physical underwriter, and that's the person that you're talking to, what the audience is thinking about, is that physical person, that man or woman that is, we're asking all these things from you, and we're passing on to this particular person, and then now they're making a decision. They're not really making a decision. Right. The decision has already been made by the system. What they're doing is they're verifying the documentation that they receive. They're verifying that this documentation matches up to the data that was entered into that system used to obtain that approval. So in the system, we typed in that you made $90,000 per year. Okay, underwriter is looking at the pay stubs, W-2s. Show me proof that this person makes at least $90,000 a year.
Yeah.
Okay, cool. Check that out. You're putting 10% down. That's going to be $25,000. Show me proof in terms of bank statements for the past 60 days that this person has $25,000 in there.
Gotcha.
What it gets difficult is when they're analyzing the bank statements, they're not just looking at, okay, yes, they have $25,000 in the bank, check it off. But they're also going through the bank statement and looking for, is there any large deposits that you have in here that needs to be explained? You know, oh, I got $10,000 I won, you know, at the casino.
Yeah.
Okay, can you document that?
Yeah.
You know, oh, I just had some cash at home.
Yeah.
That's where people run into the frustrations is, why are they concerned with that? You know, why's that a big deal?
Yeah.
And so they're looking for, and that's a big deal because of, you know, they have, you know, the government has after 9/11, they have certain rules they put in place to look for money laundering.
Gotcha.
You know, you could be involved in some illegal activity, and so the underwriter's job is they're just following the guidelines.
Right.
They're just looking at, okay, well, you make $3,000 a month, you have an $18,000 cash deposit.
Right. Where's that from?
Where'd that come from?
Right.
You know, you should be able to just document it. You can't say, well, I don't know, I just had some money sitting at the house.
Right.
Okay, well, we can't use those funds because we have no way of being able to document the source where those funds came from, you know.
Gotcha.
So they're looking for things like that. And so literally, and once they've checked off, okay, all they're looking to do is to verify the data that was used to obtain an approval. Can you provide sufficient documentation to support that?
Gotcha.
Once you can, they're just check it off. That's all it is, because the system, we don't actually like scan in the pay stubs. We don't scan in the bank statements, so it's not able to read that. So you need a physical person to do that. But the actual approval itself, it's already been done.
Gotcha.
And I like it that way because you really don't want the approval in the hands of a human being making decisions as far as who gets a house and who doesn't get a house.
Gotcha.
We don't want that in a human's hands. So the system is a better way of doing it. That takes away potential bias, takes away potential discrimination, takes away a potential person's own beliefs and different things.
Right.
Who cares about that? It has nothing to do with the loan being approved. Gotcha. And so the system kind of does that, and like I say, the underwriter is just there to substantiate the data that was entered.
Gotcha.
That's all.
That makes sense. So there you have it. The underwriters are not these evil trolls.
Well, some of them, no. Majority of the time, they're good people. They're just doing their, they're doing their job. They gotta cover their butts just like we go to work every day. We gotta cover ours. Again, it goes back to being prepared.
Exactly.
If you're prepared, and those deals just flow through the system like butter. When you're marginally prepared, or you're like barely prepared, you're just trying to scrape up enough to buy a house. That's when you run into trouble. But if you're prepared to buy a house, man, underwriting is a breeze.
It's a breeze. Easy money. So, there you have it. Those are all the questions. I think from the interview I received, what I got from it is you need to, if you're in the market to purchase a home, you need to position yourself to be, position/prepare yourself to purchase a home, and you need to, in order to do that, to position and prepare yourself, you need to change your mindset in order to position yourself and prepare yourself. But that's a whole other interview. I'll probably ask Damon in for another conversation on that, on changing your mindset to be financially prepared to purchase a home and keep the home. That's a whole other interview. But what I'm going to do, I'm going to write on the board, if that's okay, your website, if that's good. Yep. And I will ask you if you have anything any advice you want to give to them before we close out the interview. The floor is yours.
No, I don't want to keep it's hard to keep everybody's attention for a long period of time, right? So I don't want to talk even further. But I would just say, the fact that you took the time to listen to this from the start to the end, it's the fact that you took the time is already a major step to making sure that you're making, better decisions. I look at it as, we put a lot of emphasis on the home because that tends to be the biggest payment that we have on a monthly basis. But that's just a part of our overall financial picture. We should be looking at everything that we have. We should be looking at our student loans, our car loans, interest rates that we're paying on credit cards. All that has an impact on our overall financial picture. And so, anyone needs any help, anyone needs any guidance, I can definitely help you there. Appreciate your time, and thanks, James, for having me, man. It's always glad to share the knowledge that I've obtained from other people and from just experiencing being in this business. And so it's always a good feeling for me to be able to then share that with others. So thank you, everybody. Appreciate you listening in, and again, appreciate you for having me.
Thank you. I mean, I won't add any more to that. Well, I will confirm. Is this correct? www.dallasapproved.com?
Not quite.
Not quite. Where did that screw up?
That's really just we're doing some stuff with the site. That's really just
get this.
If somebody wants to,
we can erase that.
Let's just give them something better.
Yeah.
It's basically if somebody wants to apply.
Okay.
Just basically it's DallasPreapproval.com.
There we go. Pre-approval.
DallasPreapproval.com. But better yet, let's just maybe give them my email. So let's maybe start there first. So it's Damon, that's an O, by the way. Sorry. At Gen Tech. I don't know if the camera's still picking this up.
I should be able to see that, yeah.
Gen Tech Mortgage. Demond, DEMOND at gentechmortgage.com. Shoot me an email there, and if it's a pre-approval conversation that someone wants to have, I know they do it for 30 minutes,
Gotcha.
And I can send you a link to a calendar. Go into the calendar, book the time that's convenient for them, and then we can talk about it from there, and then that's when we can determine if it's time to apply and all that. So,
gotcha.
So let's just start there first and go from there.
Gotcha. So there's his information. Please check him out. I'm sure he wouldn't have an issue with if you're concerned or you're confused as if you're in the proper position, or if you are prepared, you can schedule an appointment and talk to him to see if you are prepared and ready to purchase a home. So again, Damon, thank you very much for your time. I really appreciate it. Again, thank you guys for tuning in. Really appreciate your time. But that's it. You got the knowledge, you got the notes, so go ahead and do something with it. I'll talk to you guys later. Thanks.